How we doing, everybody? Just going live here to continue the real estate note investing series. This is the 5th video in the series. If you want to see the other 4 videos, just go to the YouTube channel, Abundant Capital Group. This is where I am. Just want to show you. Ever want to meet me in person? That's the street right there. It's on Glenwood and Carteret Street. It's kind of the Bloomfield East Orange border. Just come down, and I'm right down here.
Where you need a ride to, Carmen? Why should I take you to Jersey City?
So you see there's my chair, my little setup. As you can see over there, that's kind of like the main park where the track is, the field house, and then on the opposite side of the field house there is the water park. So I'm kind of down on the other side. That's the brook. So this is where I'm at. You usually here every Saturday. Maybe changing it in the future, but for right now, Saturday at 1 p.m. we kind of just go through this series in regards to note investing. Definitely see an opportunity when it comes to note investing, whether you're someone that invests already in real estate, if you do fix and flips, buy and holds. No matter what you already do in real estate, you want to look at the note business because you can do all of those things through investing in notes. Real estate notes is kind of the financing or paper side of the business as opposed to the physical real estate, but you are able to acquire the real estate through notes. So that's why we're bringing this to you. There's going to be an opportunity. There's an opportunity now, as well as a opportunity moving forward with everybody coming out of the forbearance plans at the end of this month. The banks are going to have to make a decision on about 2 million plus loans of people coming out of forbearance. And it's of my opinion that they're not going to obviously foreclose on them. Some of them they are going to modify, but a lot of them will be sold off. If you go to Fannie Mae website, some of the government-sponsored entities have already started selling off some of their non-performing loan portfolio. We'll start to see those assets trickle down kind of to our level. If you want to buy directly from a GSC, government-sponsored entity, you would have to have several million dollars, probably in the $50 to $100 million range. You can buy directly from them. Or as we do, we kind of wait until those companies, hedge funds companies, private equity companies buy them, kind of go through that inventory, and then they start to sell off smaller pools, and then they work our way down to where we can buy individual notes, or we can buy, again, smaller pools of them. So just want to make everybody aware of this opportunity. It's a good chance, it's a good opportunity to get involved in real estate investing at a discounted price. Also, you can do this with a retirement account. We talk a lot about that on my YouTube channel as well. If you go there, it is Abundant Capital Group on YouTube. You'll see some videos there when it comes to using your retirement account to invest in real estate. You can do that. You can invest in notes with your retirement account as well. Or like I said, if you're an investor and you do this and you're looking for fix and flip opportunities, you're looking for buy and hold opportunities, buying the note can get you those same opportunities. So In this part of the series, we're going to focus on non-performing notes. We're going to continue the series. Last week we talked about performing notes. We're going to kind of go through the due diligence process when it comes to non-performing notes. I'm probably going to break this up into 2 weeks because we're going to cover a few different areas of the due diligence. The due diligence is broken down into asset price, property value, the numbers, property title, property taxes, proper documentation, and then planning exit strategy. So probably going to go through like the first 4 of these: asset price, property value, numbers, and property title. Go into depth a little bit about each of those, and then we'll pick up next week with the rest of the list. So if you want to go back, like I said, and see some of the other videos, there's a series that I started on a playlist on my YouTube channel, Abundant Capital Group. You can kind of see the first 4 videos that we did in this series. And now we're on the non-performing notes. So when it comes to non-performing notes, you're going to either get, excuse me, when it comes to asset price, there's going to be either a price that the seller of the note is going to want for the asset, it's going to be negotiated, or there's going to be like kind of a bid or a closed auction to win a non-performing note. You usually negotiate price with a individual seller. Let's say somebody created a seller financed note and it has gone non-performing, the person stopped paying. We can reach out to them and we can kind of negotiate the best price. They may be looking for, what they may be looking for, maybe the price that you're willing to pay. When you factor in all of these other circumstances and other factors, I should say. Some people just want to get rid of it, especially if they're an individual investor, mom and pop, smaller investor. They just may want to get rid of the headache, and you probably can get a non-performing note at a really good discount. Usually when you're dealing with note investment companies or some of these larger companies that buy directly from government-sponsored entities or enterprises, they'll usually list a price. Some will say, do your due diligence and come back to us with a price. So you'll see either one of those when you're buying from, those other two, those other places when it comes to who has the inventory. So now we're going to property value. This is very important in non-performing space. The reason being is that you're buying, obviously, something that is not paying right now, and you're most likely going to have to take this property back. So we want to make sure that we're not into the property for more than what we feel comfortable. And a lot of times that's right around 55% of the value. So you have to establish the value. And now you may want to say, well, how do you establish the value? So we established the value with some online research. We can look at websites, Zillow.com, Trulia. You have some paid sources like PropStream.com. You can look at Realtor.com. There's a few different online sources that you can go to which are free. Some are paid, but they will give you comps or give you an idea of what it is or what the value of this particular asset is. And we really got to make sure that we have a really good understanding. We don't want to be, tens of thousands of dollars off. I mean, sometimes if you're off 5,000 up to maybe 10,000, that's okay. But if you're off, 25,000 or more, $15,000, $20,000, $25,000 off of what the asset is worth, you could have an issue when it comes to non-performing notes. Because again, we may have to take this property back. This particular person is not paying each month, and we may not be able to modify them. We may not be able to restructure this loan and get them paying again. So we always have to think about worst case scenario, and worst case scenario is taking it back. And if we take this property back, where are we going to feel comfortable? You know, a lot of times we are going to feel comfortable around that 50%, 55% range. You know, as you do more of these, you may take a little bit more risk, because maybe you'll keep the property and do some other exit strategies. But we have to factor in, we don't know what's going on the interior. You know, do they, you know, are there a bunch of repairs that need to be done? You know, is there, you know, are we going to have to fix anything? So you have to kind of brace yourself for that. And if there are things that need to be done, you don't necessarily have to do them, but it would, you know, that's why we kind of factor it into the price and try to keep it in that 50 to 55% range. You know, you can increase that a little bit if you're really familiar with the area, you know, or have, you know, someone that, you know, buys at a certain amount, and you can go a little bit higher on your offer because, you know, you can turn it right over to them. You know, you may want to do that, but a lot of times to feel comfortable, you want to be around that 50 to 55% range on a non-performing note. And so when you're looking at those online sources, what happens sometimes is that you get a wide range of prices. Sometimes you get $100,000 for a property, and another site will say, well, it's worth $140,000, and then another site will say it's worth $75,000. So if you see big disparities in the price, what you want to do is kind of confirm that, or get a better idea by doing a BPO. A BPO is a broker's price opinion. You're reaching out to somebody local in that area who knows that particular market, knows those properties, and they're going to give you a price opinion on what they think the property is worth. They usually back it up with listed comps, sold comps, and pending comps, and it's a small little report that they do. They do, you know, it is a charge for this. It's probably somewhere between $100 to about $150 to get one done. It's better to go ahead and spend $100, $150 to confirm the value than to spend, you know, thousands, $25,000, $50,000 on a note, and it's only worth maybe a little bit above that, or you're in it for, you know, 80, 90% of the value. You know, now you've got more money at risk as opposed to $100 or $150. So when you see those big disparities, what we want to do is get that BPO. Even in probably before even ordering a BPO, a lot of times you can reach out to a local agent. If you're not buying somewhere that you live, if it's in another state, you can reach out to 2 or 3, 4 different realtors. A lot of times they'll get on the phone with you, especially if you tell them, look, I'm an out-of-state investor, I'm buying this non-performing asset, and when I get it, I'm going to have to use somebody local to sell it for me. If that happens, you know, obviously they would like to get that business, so they'll probably work with you and get you the information that you need and give you a good indication of what the property is worth. And again, we have to take in the factors that we don't know, some unknowns about the property condition on the inside, so that's why we want to hedge our bets, so to speak, in terms of what we pay for it. You know, so the BPO could give you a good idea of what the property is worth. Also, the BPO, sometimes you get them and they're not that great. You know, what you can do is maybe order another BPO, maybe from a different company, a different person to do it, and to see if you get some better information. Because, you know, I've seen BPOs where they just have one comp, one sale, one listing, and one pending. But we're trying to look at 3 or more so we can, you know, kind of get a good idea of what this property is worth. And then usually, you know, we want things that are within similar square footage, within about maybe a mile of the property. And when it comes to sold, we want things that have sold hopefully within the last 6 months, if not longer. If not any longer than a year, just depending on where it is. So a BPO is a great way to get that property value, and that's your starting point. Is the property value. If I know that it's worth X, I know that I'll feel comfortable purchasing at Y. So we have to get drilled down on that BPO value as best as possible. So now the next thing is numbers. When it comes to numbers, we're looking at that investment to value ratio. A lot of this is very similar to what I talked about last week in terms of the performing notes. We're always concerned about the investment to value. Are we in a good investment to value ratio? And that's why we want to purchase at that 50-55% range. This way we know that we are protected. If everything goes bad and we have to take this property back, we know that if we didn't want the property, most likely we could just unload it on the open market for something above that 50-55% value, make all of our money back, hopefully a small profit as well, but at worst, we could probably break even. And if we couldn't, maybe we do put a little bit more money into the property to bring it up to a certain level and then sell it. Maybe by putting, some new flooring in it, painting it, doing some minor repairs and stuff like that. It'll bring it up to a certain value and then you can sell it. And again, at worst, maybe break even, but obviously we want to, make some gains. So, that investment to value is extremely important. When you are buying, whether it be performing or in this case that we're talking about non-performing. Now, the unpaid balance. We look at it, but this person isn't paying. The only time that we want to really focus in on the unpaid balance when it comes to a non-performing note is if we have indications of this person wanting to do or being able to do a modification. Do they have, are they showing signs of that? If that's the case, then, obviously the unpaid balance is going to be something that we want to know, along with any arrearage account, and so we can structure a modification. Maybe this person just needs us to relieve them, bring their payment down $100, $150, maybe $200, and because we're doing that, because we bought at such a good discount, we're still getting the return and the yield that we'd like to get on this if we can do a modification. So we want to know, do they have more, or do they owe more than what the house is worth, or do they owe less than what the house is worth? If we can get an idea of that, if they owe less than what the house is worth, then that's what we call equity, and that's the next thing on the list here, equity. If they do have equity, if somebody has $20,000, $25,000 or more dollars, even maybe $10,000 or $15,000 worth of equity, they may want to, see if they can work something out to keep that equity, keep it growing. If someone has negative equity, then obviously they may not have the same incentive to try and save their equity in doing a modification. But if you see a non-performing loan that has a good amount of equity in it based on your due diligence and what you see initially, maybe that is a good candidate for a modification. They can get themselves back on and paying. We can restructure things. We may be able to forgive some of the debt because we know that this person, if we can get them back paying, maybe we can go and then sell this note. Maybe that person, if they can get back paying, will go ahead and refinance and be able to pay you off as the note holder. So these are some things that, when it comes to that unpaid balance, we want to look at it. But if we know that the property is vacant, it really doesn't matter. Nobody's living there. The person has kind of walked away from the property, so it really doesn't matter what they owe. But if somebody is still in the property, showing signs of trying to make a payment, maybe they're not making the full payment, maybe they're making a portion of it, or they're just missing months here and there, these are indications that somebody may want to stay. And we have the ability, again, because we buy at a discount, to restructure things and work it out with them. So again, if they have equity, they're probably a better candidate for a modification. Next thing we want to look at when it comes to the numbers is the neighborhood rent. A lot of times, in a lot of areas, you can find that it's actually cheaper to own a property than it is to rent one. You'll see in certain neighborhoods that it'll be $800 for the 3-bedroom, 2-bath. But in that same area, they're able to own that property, pay principal and interest of $550. And then the taxes in a lot of these areas are pretty low, so that doesn't raise their monthly payment a whole lot. You know, maybe with taxes and insurance, they're paying an extra $125. So they'll be paying maybe $625, but the rent in that neighborhood may be $750, $800. So this person most likely is going to be more incentivized when it comes to a non-performing situation to work something out, because they know if they leave this house and go somewhere else, they're going to actually be paying more. So why wouldn't they want to stay, you know, and get something worked out? So knowing that, you know, there are some good places, some good online sources. Rentometer.com. Zillow has a for rent section. They can give you an idea of what rents are. So if you see that rents are, you know, above where this person is paying, you know, that'll give you maybe a good indication that you can work something out. Now, if it's more, then obviously, you know, the reverse comes into play. They're probably looking to go rent if their mortgage is more than, you know, what it costs to rent. So the next one here is property title. We have the liens and encumbrances. We have to make sure that we pull title, you know, before we purchase a non-performing note. And then also part of your own due diligence is looking at public record. Public record, a lot of times, a lot of counties, a lot of municipalities will have information as to any liens or encumbrances on a property. So you know, then have to figure out which ones would jeopardize my position as a first lien holder on this particular property. You know, you have some voluntary liens and then you have involuntary liens. So we have to see and evaluate, you know, which ones can jeopardize me as being the note holder in first position. And a lot of times that's one of two things. In every state, it's taxes. You have to know what's going on with the taxes. If the person is not paying their mortgage, most of the time, a high percentage of the time, they're not paying the taxes either. But in the rare case that they are paying the taxes, what does that tell you? That tells you that this person is looking to stay. If they're keeping up, paying the taxes, I mean, they most likely would like somebody to reach out to them and see if they can work something out with that principal and interest payment. So that would be a good sign. But again, most of the time they're not paying the mortgage, they're not paying the taxes and the insurance. And, you know, we just want to make sure that the taxes are not in a place where they were sold. A lot of times you can do a tax certificate. You can sell those. And then there's a certain amount of redemption period. We need to know that if a tax lien was sold, and then how much it's going to take to cure that, because if that person, after that redemption period, then they can file what's called the tax sale. And then the tax sale deed, meaning that that particular person that bought that tax lien certificate now would own the property through foreclosure and wipe out you as the first lien holder. So you have to be very mindful of that. Now the other thing is the HOA fee. In certain states, the HOA fee can supersede a first position note. If that's not paid and the HOA, you know, wants to foreclose for non-payment of dues and fees, they could, you know, foreclose on a property and take the property back themselves, and you as that non-performing note holder could be wiped out of your position. So, you know, we have to pay attention to that. A lot of times, too, when it comes to taxes, when it gets to a tax lien sale or tax lien has been sold, it's usually because there's been a number of years of not paying the taxes. So maybe it's 3 years, 2 years, 4 years, but you can maybe verify with somebody in the tax department like what needs to be paid. Now maybe they don't have to pay all the way up until that particular year. Maybe you can pay a certain amount just to get it reinstated and, taken off a list of it being sold or up for sale, the tax lien being up for sale. Maybe if you paid the two back years, and then you have time to kind of catch up on that third year that's missing, maybe you could do that. But for each state it's different, and you would have to contact the tax department in that particular city and county that you're buying a note from. Now, be mindful a lot of times that they're going to want you to pay it all, but then that may not necessarily be the requirement. So you may have to ask a supervisor or a manager, tell me what exactly it is I have to pay in order to keep this from a tax lien certificate sale. And again, it may not be the whole amount, it may be a portion to get you in a good standing, and then if you're able to work something out with the homeowner, that can be added into the price, to the new terms, and hopefully they'll start to get back on track to pay. And maybe part of what you work out with them is take a certain amount to pay any back taxes if you are doing like a modification or something like that. So the title report is going to tell us, if we missed something through going through public record, if we didn't see that, they had a voluntary or involuntary lien on the property, the title report is going to point that out, and we may be able to negotiate some of the things on there, just pay off certain things. Or a lot of times if things are on there, what we can do is we can renegotiate the price of purchasing a note. Look, I want to buy this, but I'm going to have to pay, XYZ for this, and can I get a break on the pricing? If there's been some new liens and new things that come up on it, whoever's selling it may say yes. So that's a good thing to know, and you want to keep your eye on it and make sure that your first lien position is not being jeopardized. Sometimes when you're buying these notes, you're buying them from banks, maybe they've done a BPO. Maybe they've done a title report within the last 90 days or something like that. Maybe the individual that you're purchasing a note from, has a recent title report. A lot of times you can get that from them and maybe go back to that company and just ask them for an update. It's a lot less expensive than having to run a full title on something. So again, those are things that you may be in a position to do, just depending on the situation with the note. And then you want to know which liens can I negotiate with, and if I can't negotiate with, then maybe I'll have to pass on the deal. Maybe the liens that are on there are just too much, and I can't afford to pay all that and still be in a good position. And then also when you do one of the exit strategies that we're going to talk about, I won't get into it right now. I'll talk about it when we get to exit strategies. So like I was saying, there's types of liens that you have. You have voluntary and involuntary. A voluntary lien is like a mortgage, that is put on a property, some type of security agreement that's on the property. So you're saying that if I don't do what I'm supposed to do to pay you back on the note, you can put this lien on the property so you can take the property back in case I don't pay. First mortgage or second mortgage or even a home equity line of credit. Again, this is voluntary. You're saying, I want to be able to access $50,000 or $100,000 from a line of credit, and when I do, they'll just put a lien on the property for that amount in case you don't pay. Some of the involuntary ones, we've talked about property taxes, HOAs, utilities in some places. They will attach to the property if they go without being paid. Some judgments can be put on the property. Most times with judgments, they go more with the person than the actual property, but they will attach it to the property, if thinking that when this person sells, at least we can get paid off. But a lot of times with the non-performing, there may not be enough money there to satisfy, a judgment that was put on, because you pay down the liens in terms of seniority, who's the first lien holder, second lien holder, and so forth and so on. You pay when the property, if the property gets foreclosed or anything like that, it gets paid out in that way. So a lot of times judgments are at the bottom of the line and they don't get paid out. The person will take it off and just attach it. Whatever company has the judgment on it, and they take it off of the property, and it'll go with the person because they know they can't get anything out of the property. You have federal and state income tax can be applied as a lien on a property. Again, most of the time in this situation, they don't want the property because they're not in the business of taking back foreclosed property. So a lot of times we can negotiate with them. Maybe it's an amount where it can just get paid off. Or most of the times what happens is that they just release it and then they'll still keep the judgment for the individual, but not on the particular property. So we just have to know what we're dealing with. And then based on what's on there, what can we do? Who do we reach out to see if we can get this resolved? And 9 times out of 10, you can get a lot of things resolved when it comes to the types of liens. So when it comes to, again, I was talking about lien priority. Usually it's first in time, has the first in right. But a lot of the state laws have exemptions for certain things. And in one case, it's the taxes. If they're not getting that tax revenue, the state is putting in laws saying that will go ahead of any other lien, if you have to take the property back due to non-payment of taxes. So that can jump your first lien position. And again, other states allow for the HOA fee to do that same thing. So we have to understand, where we're buying and what are the laws and what are the ramifications if someone is behind on certain things and you see certain things on the title. Is it going to be worth me spending the money to do it? And a lot of times it is, because we're buying at those discounts. And then two, you can go back to the seller and say, hey, I don't know if you're aware of this, but this has these liens attached to it that I'm going to have to most likely take care of. So can I get a better price? Sometimes you can renegotiate it if things have come up since the last time a title was run. Sometimes people hold on notes 2 years, 3 years, and they don't know, what's been put on there. So you can go back to them and say, I need a little bit of a discount on this, or more of a discount, because I'm going to have to pay X, Y, Z. So, those are about the first 4 things when it comes to, real estate notes or non-performing notes that we want to, kind of pay attention to, and what we look at when we're doing due diligence. So if you're somebody that works with us, these are some of the things that, we do. We research, we look into, and then we can report back to you and say, hey, based on my due diligence on this, and we'll kind of go through each of these areas to kind of tell you why we think that this is a good note to purchase. But if you're going to be obviously jumping into this and doing it yourself, these are things that you want to evaluate. So the next week we'll go into property taxes. We'll go into proper documentation and the exit strategy. So we just try to take a little bit deeper dive into things, here on Saturdays when we do these. We also do them during the week. We have a note talk Monday nights, 7:30 p.m. Actually, right now it's on Tuesday nights at 7:30 p.m. We take certain aspects of the note industry and we just talk about them for, maybe 15 minutes or so, 20 minutes. We try to keep them short. But here we try to go a little bit more in depth into what, goes into our thinking and what we're doing. And again, it goes to this series that we're building in terms of note investing. And right now, you can get this information for free. I got the information, I had to pay for it. It's going to be free for a little, for some time, but at some point, this information is not going to be free. So, you want to take advantage of looking at those videos, getting a better understanding of this, and, looking at the opportunity that's out there now and what's coming. So just to reiterate, we went over the asset price, how pricing happens, and we talked about the, knowing that property value is very, very important, because we don't want to overpay for anything. Just like anything else that when you go shopping, you really don't want to overpay for things. You want to buy them at a good price or a discount price, and that's especially true when it comes to non-performing notes, because we're taking on, something that's not paying, and we're most likely going to get this property back. And then we talked about the numbers in terms of the investment to value. You don't want to be more than about 55%, and you can find things as low as 25 cents on the dollar, 25% of the market value of the property, which are really great deals. There may be some issues with it that need to be clarified and fixed up, and may cost you, some more money. But if you're buying something at 25%, 30% of value, and you have to spend an extra, 10% of money or 15% of money, you're still, in a really good position when it comes to notes. We talked about the unpaid balance, why we want to look at that, and why in some instances it doesn't really matter. And we did talk about the property title and kind of like lien priority, what can cause you some issues. Pretty much the taxes and or HOA fees in some states, but mainly in every state it's the taxes. Want to make sure that that's taken care of. So with that being said, we're going to sign off, because it does look like it may rain at any minute. It's starting to get a little gray out here. As you can see, some of these clouds are forming, but we just want to, let everybody know that there's an opportunity out here. You can still do fixing and flipping. You can still do rentals if you like rentals, through the note industry. The forbearance agreements are ending at the end of this month, and there was they were saying that they're most likely not going to extend them anymore, so the banks are really going to have to make a lot of decisions on a lot of loans, and there's going to be an opportunity for investors or people with capital to look into note investing, buy them at a nice discount, and be able to help a lot of families out here that need it, by modifying loans, or if people don't want the properties, maybe helping them get to their next destination, and then you get in the property and maybe providing affordable housing to someone else. So if you have any issues with the property, if there's a homeowner out there that has an issue, we do look to help homeowners that are having issues with property, whether it be an investment property or your own residence, to give you some solutions. There may be things out there that you're not aware of and don't know about that could help you through your situation. So if you'd like to talk about your situation or know someone, please reach out. My telephone number is 973-475-8488, or you can email me at acg@abundantcapitalgroup.com. But if you're watching this on the replay, please like and share. If you're somebody that's not investing right now or don't think you can, please share this. And if you have any comments, things that I can do better, questions that you may have that you'd like to be answered, please ask them. And go check out the other 4 videos We kind of go step by step, and this was just the next part in the series. And then we'll be coming back with part 2 of this next week. So be looking out for when I post on my Facebook, which is my name, Gilbert Ross, or I have a business page, which is Abundant Capital Group. So you'll see it on there, or I'll be posting here on Instagram, but it will be next weekend as well. So everybody have a good rest of your weekend, and we'll talk to you, Tuesday. Try to come check us out on Tuesday. We'll go live on Facebook as well as Instagram, and we're again talking about notes, different part of the note industry. We pick a topic and we go for about 15-20 minutes. So join us then, or on Thursday 7:30, where we're talking about self-directed IRAs. All right, have a good one, everyone.